Good morning, folks, and welcome back to Almus Market Mornings. There's not been much of a change in the theme from last week. Generally, the sentiment has been positive. Energy stock is flowing through the Strait of Hormuz without much of a problem. Dollar index is broadly holding on to its strength despite a weaker jobs number, and the Indian rupee saw a bout of weakness, but nothing that seemed concerning and well within the movement in the regular channels. One interesting point to note, and something we cover in our weekly fixed income bulletin, the bond flows under the FAR or the freely accessible route has been picking up, including expectation of inclusion in the Bloomberg index. That's pulled down the India 10-year yields by about 28 basis points in a month to its 11-month low. India, of course, is trying to build various avenues for capital flows, including the FCNRB route. Good morning, JK. What's your broad take on markets going into this week? Are we expecting the dollar strength to pick up again?
Good morning, Raj. Frankly, last week we did not have too many surprises as far as the markets are concerned. Um, I mean, I would say nothing compared to the surprise of Brazil exiting the FIFA World Cup final, and this happened after several years, and defeat to Norway by 2-0. And I think the world over, all the football fans are somewhat shocked by this news. But no such shocks as far as the markets are concerned yesterday, rather last week. In fact, Friday was a very um, quiet day because US was closed, and the market was still trying to reassess the implication of the US non-farm payroll that disappointed on the headline, coming at very low 57,000 compared to 122,000 that was in the previous week. But I would say market's initial knee-jerk reaction was because the market had expected a higher number, and other indicators in the week were leading to a much better number, like the job openings or even the job cuts data. All of them were indicating that job market was good, and even the ISM services and PMS employment components were stronger. So. I think the knee-jerk reaction was only because the dollar had gone up, uh, quite a bit in the last 1 month. In fact, the data as well as the dollar came full circle from early June to early July, because in June, market was shocked by a very high non-farm payroll number at 1,72,000, and that led to a huge short covering in the US dollar. Then, since then, whatever we have seen in the US economy has been strong economic data. GDP came much higher. PMI of both manufacturing and services have been holding up well. And in fact, the asset markets have been, though there has been a lot of volatility, US markets have been still performing better. So the dollar demand is, at the moment quite sustained. And at the same time, we had data from Europe on the inflation side, which indicated that ECB might be going a bit slow on their rate hike, particularly in July. There may not be any rate hike. Oil prices stayed lower. So other countries, including Japan, also may not hike the rate in a hurry, having already hiked the rates in the previous month. All of this actually supports the dollar, and whatever we have seen as a drop in the dollar index immediately after the non-farm payroll index, non-farm payroll number was a knee-jerk reaction. I would say some sort of a profit taking on the dollar longs, but importantly, the 100.50, which was the breakout level for the dollar index, after consolidating there for over 12 months, was held, and now we are seeing some sort of a support coming, and also we see the dollar index jumping there, euro coming off from the levels at 1.1460. Dollar in fact, had a sharp retreat from 162.60, and it's not entirely due to non-farm payroll data. It was because of fears that Bank of Japan might use the thin market conditions to intervene. In fact, there were some rumors that there has been a rate check by Bank of Japan, but I think all that I would consider those retreats by USDN also as a profit taking, because market had built up quite a bit of long position when Bank BOJ did not appear even out of the break of 162, and we see the rates now once again moving towards 162 today morning. So all in all, dollar strength has not been threatened. In fact, if you look at the policy implication of the non-farm payroll data, uh, you know, Kevin Marsh is very clear whenever he has spoken of late that Fed remains committed to 2% inflation target being met, and there is not much of a concern on the employment situation. So all this, in fact, means that the Fed rate hike prospects in September has not been threatened. So we continue to expect, you know, dollar to do some more recovery. Of course, eventually, medium-term dollar softness might return, but as of now, that is based on structural factors. But as of now, the cyclically dollar seems to be very well supported. Now, for the local dollar rupee, of course, it was a reversal of a different chart that was seen last week, because rupee was uh, quite strong, to start with in June, after the host of measures were announced by government and RBI. We almost broke 94, but just held. But that level actually held for quite a few attempts. And since then, some hiccups have arisen. One was, for the concern about the monsoon, which was, deficit. Then some regulatory hiccups were being talked about as far as a uh, leveraged FCNR funds being raised by banks on behalf of RBIs. There were some rumors that, or market talk that at the low 94s, the central bank itself was buying some dollars. So all these things led to renewed buying by importers, and of course, as usual, when the key level at 94.80 and 95 broke, there has been quite a bit of stop loss buying in the US dollar against the INR. So I think it was sort of a sharp correction to the rupee's strength that was seen earlier in June, after we had the announcements by RBI and government, as well as oil prices retreating to pre-war levels. In fact, currently oil prices still hold there, and as you mentioned, the flows for the bond market is expected to be steady. In fact, last 3 weeks we have seen a positive flow from FIS. This has happened after a very long time, and we expect this to continue as far as the bond market is concerned. And as and when things are sorted out as far as the FCNR flows are concerned, we could see more flows. I'm not talking about rupee, rallying, in a very sharp manner. But I think at the same time, upside also perhaps remains capped, because there is still expectation that there will be some flows. Oil remains at the lows, and Indian market, equity market also, in fact, has been holding up well despite many attempts to break lower. And I think it's a matter of time. Probably some value buying in Indian stocks also might happen with the rupee, if the rupee stabilizes, in a range. So I think we expect the rupee also to move in the range, new range. Perhaps the range now shifts to 94.80 to 95.70 or so, and we should not expect any major, fall in the rupee for now, due to fundamental factors. Reports also indicate in the first week of July, a lot of deficit of rainfall in June has been made up. The deficit has come down from 40% to 24%. So I think there's a mixed bag of news for rupee, but not all is bad. So I think rupee holds to this new range for some time until we see fresh developments. Thank you, Saraj.
Thanks a lot, JK. And for our listeners who don't know, JK is in the UK. And, he's been recording at, I think, God knows what time is it, JK, there?
It's about 3:30.
Yeah, 3:30 in the morning. I mean, that's the level of consistency we have seen in this podcast. And no matter where JK is, whether he's in the UK or he has been to the US a few times. But I think at the time of recording, UK is a bit more awkward for him than the US because of the time difference. But yeah, so that's the consistency we have been seeing. So thank you, JK, for
Oh,
taking the time out and really helping us to continue this podcast throughout. I mean, that's how we have been able to manage to do so many episodes. So thanks a lot.
pleasure to do that, Swaraj.
Yeah. Uh, Apart from that, guys, we have covered various aspects with respect to markets. Dollar remains strong, and it is expected to continue to do well because the underlying factors are supportive of it. And with respect to the rupee weakness we have seen recently, it was just a correction to the strength earlier seen. As of now, no major fall in the rupee is expected. It remains well within that range. That's it from us today. Thanks a lot for listening. We will catch up tomorrow with the fresh round of updates.